Click the bell icon to get latest videos from Ekeeda.
Hello friends, we'll be discussing certain details about how to solve a or rather a problem related to partial sale of asset when the WDV method is under consideration. So when we speak about partial sale of asset, we basically talk about a part of asset being sold out, or rather a part of the machinery or product being sold out completely. So when we talk about depreciation, we rather have to include the depreciation for that specific asset, which is divided further into two parts. One that is not sold, second one which is sold out. So the depreciation has to be calculated in two ways. Rather, the first method that we have already understood is the SLM method. This method that we'll be doing further is the WDV method. So whenever we speak about any kind of details being provided further for giving out depreciations in here, depreciation rather means depreciation for that specific asset which has been sold out partially. Rest other assets still remains the same because there is no change in it. So what we'll be doing further is that we'll be going ahead with an illustration which we'll be jotting down here. You can make sure that all these details are carried or captured in your books, and rather you can go ahead and solve that, or for your just reference in near future you can use it. So we'll be jotting down one illustration. Let's go ahead and figure out how that illustration can solve your clarity on this kind of problem which is related to partial sale of asset under WDV method. Let's figure it out. So if we can figure out, we have mentioned all these details in this specific illustration which relates to Mrs. AB Corporation Limited. Now AB Corporation Limited has given out the depreciation details for the year 2018. The start of the month is Jan and the end of the year is December. That means the tenure that they are looking for starts from January and ends in the month of December. So the financial year is from Jan to December, and this is for the year 2018. That means the details have been provided according to that specific year itself. Now there are a few more additional details that they have mentioned. Let's go through them one by one and we'll understand how the timeline is supposed to be prepared. On 1st of March 2018, machine 1 was procured for rupees 10 lakhs is what they have mentioned here. On 1st of April 2018, machine 6, which was originally purchased in the year 2016, was sold out for rupees 7 lakh. The original cost of this asset was around 9 lakh rupees. They have mentioned the date, also will highlight it. So this machine 6 was originally purchased in the month of Jan. 1st of Jan 2016, this machine was purchased for rupees 9 lakhs. However, in year 2018, they have sold it out for rupees 7 lakhs. 1st of August 2018, machine 2 was purchased for rupees 15 lakhs is what they have mentioned. 1st of September 2018, machine 5, which was purchased, was sold out for rupees 10 lakh. This original cost of this machine was around 30 lakhs. However, this was only the part of it. So when the part of it was original costing 20 lakhs, which was sold out for rupees 10 lakhs here. So if you can see in this illustration, rather the last illustration or the last transaction whereby they mentioned that the machine 5 which was sold out for rupees 10 lakhs, it was a partial machine that was sold out. The total cost of that machine was around 30 lakhs, out of which cost of 20 lakh was sold out to 10 lakh rupees. Now you have to figure out the rate of depreciation being given to you as 10% on WDV method. If the same is applied here, how do we figure out the depreciation on the sale transaction? How do we compute profit and loss, and what is the value of all the assets that we have until the end of financial year 2018? So let's figure it out with the timeline first. So if you can see, we have mentioned the timeline here, which consists of four important transaction details of this specific illustration. We'll go through them one by one. The first one relates to the machine 1 which was procured in this specific year. On 1st of March 2018, machine 1 was procured for 10 lakh rupees, and the total tenure for this specific depreciation providing asset is around 10 months. That means from March until December we have 10 months of depreciation to be provided here. The original cost of this machine is around 10 lakh rupees. On 1st of April 2018, another machine which was sold out for rupees 7 lakhs. The original cost of this specific machine was 9 lakh rupees, and this was purchased in the year 2016. So from Jan 2016 until April 2018, we have figured out that it is 2 years and 3 months. That means this transaction has taken place, and that is the value of the asset, or that is the tenure of that asset. On 1st of August 2018, we have another asset that was procured for 15 lakhs, and the tenure was around 5 months for providing depreciation after the purchase date. On 1st of September 2018, we have another asset which was being sold out for rupees 10 lakh. The original cost of that asset, or rather that partial asset, was around 20 lakhs. The total cost of that asset was around 30 lakh, and this was procured in the year 2015, April 2015, and was sold out in the month of September. That means August will be the last date that we'll have to calculate. So it will be 3 years and 4 months here. So it will be 3 years and 5 months here that will be used for calculating the depreciation tenure. So apart from this, this is the timeline that we had to prepare. Let's go ahead and prepare the working note for the same. So if you can see that you have done the working for machine number 1, the cost which was mentioned was around 10 lakh rupees. Rate of depreciation was 10% on this, and this was supposed to be provided for the financial year 2018. Now this machine was purchased in the month of March. So from March until December 2018 you have 10 months of period. So the depreciation will be calculated as the original cost of the asset multiplied by 10%, as that is the rate of depreciation, multiplied by months divided by total number of months in a year. That means 10 upon 12. That gives you a total depreciation of 83,333 rupees. So when you know that this is the depreciation that is supposed to be provided here, now the written down value of that specific asset by the end of this specific financial year, that means December 2018, will be somewhere around 10 lakhs minus 83,333. That will give you a total of 9,16,667 rupees. So this is what the total depreciation, or rather the depreciated value of this asset is. So we have done the working for machine number 1. Let's do the similar kind of working for machine number 2 and figure out whether we have a profit or loss in that situation in the next sheet. But before that, let's understand the value of that specific asset. So if you can figure out, we have done the working for machine number 6 as well. The cost of this asset was around 9 lakh rupees. Now if you know that the cost of this asset is around 9 lakh rupees, the rate of depreciation is 10%, and the tenure which we have mentioned in the timeline is 2 years and 3 months. So from Jan 2016 until December 2016 we have a flat 10% depreciation on it, which will be 90,000. Now this 90,000 will be subtracted from 9 lakh rupees, and whatever is the balance value, that will be the opening balance of next year's depreciation, that is 8 lakh 10,000. So next year, that is in year 2017, the depreciation will be provided on this specific amount, that is 8 lakh 10,000, 10% on it, which will be 81,000. Now once you subtract 81,000 from 8 lakh 10,000, you have a total balance of 7 lakh 29,000 coming into the picture. That is the opening balance of the next financial year 2018. That means Jan 2018 you will have this amount as the opening balance. Now for the year 2018 we have sold out this specific asset. The complete sale of asset was done in the month of April, 1st of April. So depreciation has been calculated from Jan until March for 3 months. So for 3 months, the depreciation count that was figured out was 18,225. Similarly, 7,29,000 multiplied by 10% multiplied by 3 divided by 12 gives you this amount of 18,225 rupees. Now once you subtract this, you get a total which is the remainder value or the written down value of that specific asset as of 31st March 2018. So 710,775 is the amount of return down value for this specific asset. Now that you have these totals mentioned here, it will be easy for you to calculate whether there is profit or loss in this situation, but we'll do that in the next sheet. So we'll figure out the total book value of this. Now let's compute the next two details in the next working sheet. That means for the next two machines. Let's figure it out in the next working sheet now. So we've done for the working for machine 2 as well. The original cost of this specific asset was around 15 lakh rupees. The rate of interest was 10%. That means the rate of depreciation on this was 10% WDV method, and the tenure was 5 months because this machine was purchased in the year 2018, August 2018. So from August till December, because the financial working is from Jan to December, from August to December you have 5 months of tenure. So if you calculate the depreciation, you get a depreciation around 62,500 here. Once you subtract this depreciation from the original cost of the asset, that means the written down value for that specific asset as of December 2018 will be 14,37,500. Similarly, we'll figure out the calculation for machine 5 as well. So if you can figure out, the machine 5 has been segregated into two parts. One which is for 20 lakhs, second which is for 10 lakhs. Now the second part, which is for rupees 10 lakhs, you have to calculate depreciation on the usual basis. However, the one which is for 20 lakhs was sold out for rupees 10 lakhs. That is the partial sale transaction that we are dealing with in this specific transaction. So let's figure it out according to the similar way. So if we can figure out for machine 5 as well, we have made the following conditions, or rather we have made the following calculations in a similar way. How we have done is that we have segregated the 30 lakh cost into two parts. 20 lakh is the one where there is a partial sale of asset. 10 lakh is the one where there is no sale of asset. So it will be going on continuing under the WDV method. So for April 2015, that means the date when it was purchased, from April 2015 until December 2015, we have calculated the depreciation here. Let's figure it out. So for 20 lakhs at the rate of 10% multiplied by 9 months, that means from April until December, we have figured out the depreciation for both 20 lakhs and 10 lakhs here. So for 20 lakhs, we have depreciation coming up as 1,50,000, and for 10 lakhs, we have coming it up as 75,000. Once that is segregated or subtracted from the original cost, we have a total value coming up here, and that will be the opening balance of the next year. That means December will be the closing balance. December 2015 closing will be the opening of Jan 2016, which we have figured out here. Now on the similar terms, we'll be going ahead and subtracting the depreciation for December, or rather we can say from Jan 2016 until December 2016. So 2015 has been done. December 2016 depreciation will be calculated in this year at the rate of 10% on the written down value, and this will continue for the year 2017 as well. So we've done it for 2016. Let's figure it out. 10% depreciation has been segregated, and the balance which has been left in the year 2016 will be the opening balance of the next year 2017. Now this same balance will be used for deriving depreciation for the year 2017. This is the most crucial part, because in the next year, that means in the year 2018, we have sale of assets. So we have to understand that the written down value of that specific asset until 2017 will be the opening balance of 2018. So that's what we have figured out. Now we'll take this working to the next page and understand whether there is a sale or profit or loss in the sale transaction. Let's figure that out now. So as you can see, we have figured out the depreciation for the year 2018 as well. The only difference is that out of these two bars that we have segregated, for 20 lakhs total, we will be calculating only for 8 months depreciation, which we have figured out as 99,900 rupees. However, for the other 10 lakh, we will be calculating it at 10% for 12 months itself. So that will be 74,925 rupees. So the book value of that specific asset which was partially sold out was somewhere around 13 lakhs. 13,98,600 to be precise on the book value of that specific asset as of August 2018, because on 1st of September you have sold it out, and that was for rupees 10 lakh. So similarly, the WDV, that means the written down value is high, however the sale price is low, so there is a loss that you have suffered here, which is for somewhere around 3,98,600. So this is how the calculation for all these depreciation has been done. The next thing that we'll be doing is that the calculation of profit and loss for both the sold transactions, and then figuring out the value of all these assets, post which we will mark the closure of this sum. Let's figure out the profit or loss on the sale transaction. So as you can see, we have figured out the loss for machine number 6, which was sold out. The total cost of that specific asset was somewhere around 9 lakhs, for which we have calculated the total depreciation and figured out that the written down value of that specific asset as of 31st March 2018 was somewhere around 7,10,775. However, this asset was sold out for rupees 7 lakh. That means WDV is high, sale price is low, so the difference is the loss that it has suffered due to this specific transaction. Similarly, we'll figure out whether we have the loss or profit in the case of the next machine that we have sold out partially, because this was the complete sale of asset transaction. So we're done with the working for machine number 5 as well. The original cost of that partial machine sold out was 20 lakh rupees. Total depreciation has been figured out at 6 lakh 1,400 rupees. So the balance WDV as of 31st of August 2018 was 13 lakh 98,600. However, the same asset was sold out in the market on that time was for rupees 10 lakhs. That means WDV is 13 lakh 98,600. Sale price is 10 lakh. The difference is 3 lakh 98,600, which is the loss incurred by this specific transaction. Now that we have figured out the loss and profit here, we'll go ahead and figure out the last part. That means the value of every asset that we still hold with us. So only those assets which are still with us will be calculated, and that value of the assets will be mentioned in the next sheet. Let's figure it out. So now that we have figured out the value of all these assets, we have accumulated the total value, have figured out that whatever asset we have with us at the end of the year, that means December 2018, that's the value that has been highlighted there. Let's go ahead and underline it. So in total, we have 30,28,492 worth of asset. That means all those three assets that we hold with us, machine 1, machine 2, and machine 5 partial asset costing rupees 10 lakh we still have with us, that total is coming somewhere around to 30 lakh rupees. So this is the value, or this is how you need to figure out whenever there is a partial sale of asset under WDV method, how the rate of depreciation and how the value of every asset is supposed to be calculated. And this sum was comprehensive because it included the complete sale of transaction as well as the partial sale of transactions of assets. So I hope this illustration gave you a lot of clarity as to how to solve these illustrations within a jiffy and how to calculate it effectively so that there is no flaws in it. So thank you for watching this video. Stay tuned with Ekeeda and keep subscribing to Ekeeda.